Okay, let's do this. We're going to take a big, messy, global headline. Let's say a conflict in the Middle East that shuts down a key shipping route like Hormuz and trace it.
Right.
We want to follow that economic shockwave all the way back to your pocket here in India. That's the mission for this deep dive.
And the starting point, the vulnerability, is just so clear.
It really is. India is the world's third largest oil importer. We depend on imports for, what, over 85% of our crude oil? We have basically no buffer for a shock like this.
None at all. And when that risk appears, the market reaction is instant. I mean, we're talking about a scenario where Brent crude could hypothetically jump, $15, maybe $20 a barrel overnight.
Just based on fear.
Purely in the fear premium, because something like 40 to 45% of India's crude still comes from the Middle East, and it all has to pass through these incredibly narrow, vulnerable choke points. One incident there and prices just soar.
And for India's economy, this isn't just one problem. It's a devastating double whammy. So, one, obviously we pay more dollars for the same barrel of oil.
Yeah.
But the second part is the kicker. Because oil is priced in dollars, our whole country's demand for dollars suddenly skyrockets.
And that's where the feedback loop starts, a really dangerous one. That increased cost for energy widens our current account deficit, the import-export gap.
Right.
And all that demand for dollars to pay for the expensive oil, it weakens the rupee. And a weaker rupee makes everything else we import more expensive too, not just the oil.
So it compounds the shock. Let's bring this down from the macroeconomic level to the household, to your wallet. How does that pricier barrel of crude turn into inflation, into a higher CPI?
Okay, so the chain reaction starts with the most obvious things: petrol, diesel, and your LPG cooking gas cylinder.
The things you see at the pump.
Exactly. The costlier crude eventually means higher prices there, but the really critical vector is transport. That higher diesel cost for every single truck, every ship, it gets baked into the price of literally everything.
Grains, vegetables, your online shopping deliveries.
All of it. And we should probably touch on the oil marketing companies, the OMCs here.
Yeah, you often hear their margins are getting squeezed. Why is that?
Well, because the government, for political reasons, often tries to manage the price you pay at the pump. So when global crude spikes, the OMCs might not be allowed to pass that full cost on to you.
So they have to absorb the difference.
They absorb it and their profits get crushed. And then there's a lag effect. WPI, the wholesale price, moves first. But things like fertilizers, petrochemicals, they all use oil and gas as inputs. So you'll see food prices, the CPI, tick up months later.
The new tire you buy for your car 6 months from now is more expensive because of geopolitical tension today.
That's a perfect way to put it.
Okay, shifting to the markets. Geopolitical risk always triggers this classic risk-off mood. Foreign investors, the FPIs, they pull money out of markets like India.
Right, which causes short-term chaos in the Sensex and Nifty.
And which sectors feel that pain the most?
Well, besides the OMCs we just mentioned, it's anyone where fuel is a massive cost. So aviation, logistics companies, paint manufacturers.
Paint. Why paint?
Paint uses a lot of crude oil derivatives in its manufacturing. Same with chemical companies and, of course, tire makers. But here's how it all connects: those FPIs pulling money out.
Yeah.
That's dollars leaving the country, which adds even more downward pressure on the rupee. So the currency gets hit from both sides, from the need to buy oil and from capital flying out.
There's another angle here, though, that goes beyond oil and finance. The human capital channel. This one is really surprising.
It's massive and often overlooked. Indians working abroad sent home something like $130 billion last year.
An incredible number.
It is, and a staggering 40% of that comes from Gulf countries.
So if a conflict isn't just about oil fields, if it spreads and hurts the wider regional economy.
Exactly. If it affects non-oil jobs, construction, engineering services, that directly threatens the employment of millions of Indian migrant workers.
Which means those remittance flows could dry up.
And that would be a huge blow to household consumption, especially in states like Kerala, Telangana, and Punjab that really depend on that money. It's a much deeper, longer-lasting vulnerability than a temporary oil spike.
So let's tie this all together. What does this mean for you, the person listening to this deep dive?
For your household, the shock shows up pretty fast as higher fuel and transport costs. For anyone watching the markets, you should expect immediate volatility, especially in those energy-sensitive stocks.
Right.
The real challenge for the economy is managing all these things hitting at once: the currency, the inflation, and this threat to foreign money coming in.
In the end, the scale of the damage really depends on how deep, how long, and where any conflict happens. But here's a final thought. If you were managing this crisis, What do you think is the single biggest risk for India? Is it the immediate chaotic impact on the rupee, or is it that slower, deeper risk to the remittances that power so much of our consumption? Something to think about.